Good morning, good afternoon, and good evening, investors. Hope you're doing well. This is Scott Carson again here for another amazing episode of the podcast for you guys to dive into your day in, day out investing strategies. And we've got a special guest on here, somebody who's taken his company from just Texas roots to being outside of Texas as well and doing a ton of business, a lot of growth. Started doing this back in 2008, and it's something that you definitely want to take some notes on. If you're buying, fixing, and flipping in the state of Texas or even outside of Texas. But primarily if you're here in the state of Texas, where about 40–50% of their business still is, you're going to want to take notes because I don't think there's a better hard money lender out there to help you get deals closed and funded and make some more money. Now, who am I talking about? Well, I've known this guy for a while, like I said, going back to 2008. He is the founder and CEO of Longhorn Investments. All right. It's a Dallas, Texas-based originator and servicer of real estate loans to investors focused on the fix and flip and new construction of single residence in 10 states across the U.S. And he's originated over 10,000 loans for him and his team and over $2 billion. Now, he's also the manager of Trident Realty Investments. It's an affiliated private equity fund with over 464 investors. And get this, a whopping $222 million of capital. Now, who am I talking about? I'm talking about the man, the myth, the chief bottle washer over at Longhorn Investments, Michael Hoffman. Hey, Mike, how you doing today, bud?
I'm doing great, Scott. Thanks for having me on. I'm excited to talk to you because we haven't talked in a long time, but I've known you and known about you for a long, since I started the business.
Yeah, no, I mean, we met before. We talked at different REI expos,
Yes.
think realty events and
Yes.
different things up in the DFW market when we'd make it up there. And then, we friends with a couple of your guys that were out here in town as well, originating loans or being the local business development guy, stuff like that for you. But yeah, we guys, and then know your ex-partner Merrill as well.
Yeah.
Talked with him over the time and stuff like that. But
Yeah.
man, let's get into it because I know you're laid up, just a brand new knee replacement. So if you see him squirm on the video, that's what he's doing, trying to get comfortable there for you. So our hearts and prayers go out for you for a fast recovery. But I'm sure you probably
Thank
feel a whole lot better in about 6 months than you did beforehand, huh?
I'm sure. Yes. Listen, better. That's the plan. That's why I did it. I was pretty miserable, and so I'm making good progress.
He's a full contact fix and flipper investor, everybody.
That's right.
But let's dive into, so let's just go a little generic to begin with for those that are listening in maybe for the first time and looking to do their new deal, because we always know end of the year, first of the year, people start looking at their New Year's resolutions and what they want to do, and we all know more people come out to the local REIA clubs and stuff like that, learning how do I dive into real estate investing? I want to be a fix and flipper. I want to do that HGTV magic that they see on those fictional TV shows. What is a hard money lender? We'll go from there first, Mike.
Yeah. As simple as can be, right? A hard money lender is we're going to lend you money based on the asset, right? You want to buy a property. You're not going to live in it. It's not an owner-occupied property. You're going to buy a property. You're going to fix it up, and then you want to sell it. Or in today's market, you want to refinance it out, create a rental property for yourself. You come to a hard money lender. I mean, people always say to me, why do we go to a hard money lender? Why don't we go to a bank? And I always tell people, I've been saying this for almost 20 years now, right? The two main reasons. One, I can close a lot faster than a bank can, right? Yeah. I'm typically closing in 5 to 7 business days. And two, I'm going to give you a lot more money than a bank will, right? Our company will lend up to 100% of the loan to cost, right? So if you're going to have a purchase price of $100,000 and you're going to have $50,000 of fix it up and it's going to be worth $300,000, right? I'll lend you 70% of the $300,000. No more than 100% loan to cost, right? So in that scenario, we're going to fund all $200,000 on that property. Now, we're not going to fund it on day one, right? Day one, we're going to give you the money to purchase it. We hold on to the money for the repairs. As you do the repairs, we send an inspector out, make sure the work's been done, and then we release the money to you.
Reimburse you for the expenses and stuff like that of what you're putting in.
Correct.
That's like the big thing, making sure it's so that's the thing. People don't realize when you're getting into it, like, oh, I think I got to have good credit, be a real estate investor. I got to have a lot of experience. Can you talk about kind of what you guys do for first time fix and flippers?
Yeah.
Where the deals make sense.
For sure. And look, two different examples there, right? Because credit matters if your plan is to refinance out of the property, right? Because look, there's other lenders out there. We're not the takeout financing. There's long-term lenders out there that credit does matter. Typically, we're looking at 650, 660 credit scores, right? So we want to make sure that you're successful. So we want to know what your exit strategy is before we make the loan to you. And if you want to refinance and you come to us with a 580 credit score, it's probably not going to work out for everybody, right? I mean, we like to be very transparent with everybody, right?
Well, that's what I always say. If you got like a sub 600, you're not getting refinanced out with a the
No.
bank financing whatsoever. No.
No, it will be a challenge. I mean, even in the private equity groups, the bank financing, it's going to be hard to find a lender to do that. Now, if you want to fix the property up and flip it, right, that's a different story, right? For us, we'll go down to 600 credit score and everything. You might pay a little bit more, right? It might cost you a little bit more if you're below the 650 or 640. But one of the things that's unique about us is we do not require any experience if you want to fix up and flip a property. We believe that people that have decent credit, have a little cash in the bank and everything, and they want to get into the game, we want to help them get into the game. But what we will do is we will evaluate that property because, like you said, I think I'm up to 11,000. We've probably done 11,000 loans. So I've probably looked at 50,000 deals, right? I've looked at more deals than you have. And if we tell you we don't like the deal, it's not that we don't like you, we just don't like the deal, right? So let us help you, but we're going to evaluate the deal. We're going to get a full-blown appraisal on the deal. And if the deal makes sense, we're happy to fund that deal for a first-time buyer, right? So any of these new folks that want to get into this and everything, we'd love to talk to you.
Now that's provided. Let's just run some things in there. I love what you said. But for those that are out there thinking, A, you got to make sure that what you're buying and the repairs aren't going to go above 70% of the ARV or after repair value. And we all know values are kind of coming down a little bit.
Yes.
So when you're evaluating R, are you pulling your own comps? Are you paying for an appraisal, or are you just kind of going off of numbers and days on market to make sure it's an accurate kind of valuation?
I mean, literally all of the above. We get full-blown appraisals on every deal that we do. We run our own comps. We have software that we use that gives the value. I mean, we are trying very hard to make sure that the value that you think it is really what it is. Because look, the last thing I want to do is have you do a deal and you're not successful. You got to come out a bunch of money to make the deal work, or worst case scenario, you got to give the property back to me. That's not setting you up for success, right? And so I want to make sure that, look, we want to make sure, and by the way, you mentioned HGTV. I have a story about that. We actually did a loan on someone at HGTV. It is not reality TV, just so
Amen
we're
to
all
that.
clear.
Yep.
Just so we're all clear.
So I said that fictional TV, not reality
You
TV.
you you nailed it, right? Because look, deals don't always work, right? And so it's not always so easy, so magical. Fixing and flipping is hard, right? It's challenging. And you got to buy it right. You got to repair it right. You got to have a good contractor in there. And then you need a good realtor to help you sell that property, right? It takes a team to do this and everything. It takes a good lender to help you on this. And a good lender is someone that tells you that you should walk away from a deal sometimes.
So
Not
true.
every
That's why I
deal is a
always
good
say,
deal.
I've always said that if you're going to be doing fix and flip and rent by a local hard money lender or two, if they won't do it, ask them why. They'll tell you for a reason. And don't think that they're trying to beat you down. They don't want to foreclose or take a property back. They want to make sure you're successful, so you come back and do it again and again and again with them. Right, Mike?
Yes, that 100%. Like we want to spend time with you. We want to work with you. We do not want you to be one and done, right? We do not want you to do a deal. This is too hard. This is miserable. I lost a bunch of money. I don't want to do another deal. It's like, no, 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 no. We want to develop a relationship with you. We want you to keep coming back to us. We want you to be successful, right? Whether it's flipping properties, building your own rental portfolio, whatever it may be. So we are heavily invested in your success, right?
Mhm.
And, I tell everybody too, it's like, we put a lot more money into the deal than you do. We want you to be successful, right? We do not want to take back the property.
No, you're in the lending spot, not the buying back unfinished properties or properties
No,
that are sitting out there. That's
we,
you like to be the bank. You want to be the bank, and the big buildings are all the bank. You're in the note business like I am. That's
I am in the note business, right? I am creating paper, and I am not in the loan to own business. That is not my business, right? I do not, I can't tell you, Scott, how many times borrowers call me up and go, man, you just want to take my property, and I'm like, sir, like with all due respect, your loan with me, my average loan is about $225,000. I go, right now I have $450 million in loans on our books. Do you think I really am focused on wanting to take back your $225,000 property? Not one bit, sir. I want you to be successful, pay it off, do another deal.
Mhm.
And I've had that conversation more times than you can imagine.
Yeah, no, I can only imagine as well because I've had those conversations with our borrowers. Like, no, I want you to stay in the house. I actually make more money if you stay in the house for
Yes.
the most part.
Yes.
Because when you start thinking about how you have to get outside your lane to go and refinish the rehab, somebody else's rehab, or trying to market the property for sale, it just takes away assets and time and energy when you do what you do. in a lot of ways. But let's talk about a
100%.
couple of things here.
Yeah.
What are you guys seeing right now that's causing deals that maybe you would have said yes 6 months ago? Or is it maybe saying no? Are you seeing the days on market dragging, more competition, less quality rehabs? What's kind of the thing that you're seeing that may be mucking up the machine?
Well, you're hitting on all of them. I mean, you're spot on. Right? Look, no question, days on market have been dragging, right? Since the interest rates went up at the end of 22, beginning of 23, it is taking our borrowers longer to get out of deals. Our average borrower, the first 15 years of us doing this business, average loan turn time was 4.5 months. Now it's over 7.5 months. And so it's definitely taking longer for folks to do it. Rehabs, look, if you're going to fix and flip, your number one priority is to find a good, reputable contractor. And by the way, that does not mean the cheapest contractor around, right?
Or you trying to
Or
be a jack of all trades, right, too?
or yeah, or you, right? That is a recipe for disaster, right? We want our borrowers to go find contractors that are going to do what they say they're going to do in a reasonable time period, right? And so what we're finding right now is good contractors are super busy and it's hard to find them. So people find folks that maybe don't have the experience, and that's how you get in a little trouble, right? Number one. Then number two, if you are doing a fix and flip deal and you are not going to your property 4 or 5 days a week to make sure the contractor is doing the work that is going to be done, that needs to be done, you are setting yourself up for a problem. And by the way, if you are relying on your lender to oversee the contractor, you are setting yourself up for a problem, right? You are the owner of the property. You need to take ownership in the deal. You need to make sure the contractor is doing the work that's been done and make sure their bid is reasonable, right? I mean, that is the two biggest things right now: contractor bids, days on market for properties, right? I mean, look, you get it. There's a clog right now, right? With interest rates have been up for a little while, people kind of hoping that they come down. They're not trading properties. People with big houses that their kids moved out aren't trading down because they got a great interest rate. Why would they get out? People that want to move up can't find those properties because those other folks aren't leaving their house. It is a problem right now. We have a shortage of homes that basically started since the great financial crisis, right? I mean, that started it because home builders, that nobody would give them loans. No one let them start building new properties. And this is clogged up. We're paying the price 15 years later of mucking up the system. So we're seeing it's challenging right now. There's no question about it.
Yeah, we've actually seen that here in Austin, Central Texas, where
Oh,
it is
gosh.
a huge lack of inventory because nobody was buying or building affordable homes. I mean, the city of Austin makes it difficult in a lot of cases. Areas like San Antonio have done a really good job of building more so, but there's still that big need nationwide, and not just here in Texas, but for affordable housing. So that kind of leads me to my next question. What kind of price point do you like to stay at? I mean, I know you
Yeah.
probably do a little bit of all sizes, but where do you see that bread and butter side of things that it kind of still moving? Anything under 400,000, 300,000? I know it may be a little bit market dependent, but where do you see the stuff that actually does move?
So no, you're dead on. We've always been about workforce housing, right? And so when I first started, the average loan size was 150,000. Now it's like 225, 230,000. So ARVs, right?
300.
350 to 400, right? Under 400 is really where we like to play. We will do bigger loans, but we are very nervous about those. You have to be experienced in those deals. You got to know your market. You got to know your area. One of the things, Scott, that always becomes a problem is I have some borrowers that want to graduate, right? And so they're doing $250,000 flips and they're killing it and they're just going. And then they go, you know what? But if I do $1.5 million flip, I can make this much more money. And I'm like, yeah, but the problem is you haven't done $1.5 million house. It is a different product than what you've been doing. Pricing's different, craftsmanship's different. I mean, it's a totally different world. And so we've had some people that try to graduate and they can get in a little bit of trouble sometimes, especially if you're using that same contractor on the $250,000 property, on the $1.5 million property. It doesn't always work out so well for you and everything. So we try to avoid that. I think in my portfolio right now, I've got about 1,780 loans, right? Let's just say. I think I have 40 that are over $500,000. Yeah. Workforce housing, look, there's more of those people than any other market, right? Those people are looking for housing, young people, right? Did you see that stat the other day? The average age of a person buying a house now is over 40 years old.
Yeah, that's a 10-year increase over was what 10 years ago, something like that.
Yes, it used to be 29
Crazy.
and a half. I
Yeah.
mean, it's gotten a little crazy and everything.
Well, but you also too in markets, was it 68 out of the 105 largest markets across the country? It's actually cheaper to rent than it is to actually own a home in a lot of those places. And
Look,
Texas is one of those. Yeah.
our world is changing, right? Because like when you were growing up, like, you and I are, I'm a little older than you, but I mean, the American dream was you own a home, right? You own a home, you build a bunch of equity into it, you're going to make a bunch of money on it over 25, 30 years, you own that property, it's going to be great. That there's no guarantee that exists anymore. And so to me, the stigma of renting has gone away, right? Certainly over the last 5, 6, 7 years. And it's easier sometimes to rent. And then, if your situation changes and you want to move or you got to downsize, you want to upsize, there's properties to rent. I mean, it's just a much more, the market has changed dramatically over the last 10 years of us being in this space.
It totally has. So
Yeah.
let's dive into some of those things a little bit here. Any negative property types that you won't do? Mobile homes on land, condos, anything that you really don't like doing?
Yeah, so we won't do mobile homes because technically it's not a home. Technically it's a car, so you got to go to the DMV and it's not
Well,
actually
if
the
it's
property.
attached to
If
land,
it's
let's
attached,
make
if
that
it's attached.
clarification.
That's
Okay.
true. That's true.
Yep.
So we stay away from that also because look, part of our deal is we have bank financing. We leverage our
Okay.
notes, and so they have certain requirements that certain buckets we can do. That is not a bucket we can do, right?
Okay.
Condos we've always shied away from. Like we've done some, but we're not crazy about owning air, right? Like you don't own the land, and then especially in Texas, you got to be careful because those condo associations are very powerful
Yeah.
and they can assess you, they can fine you, they can put in new compliance issues, and you have to comply. So, look,
Special assessments too that can really jack up your prices. Not we're not seeing extremes like what's going on in Florida, but
no.
we've run into that as well.
Hey, well, so I mean, just for example, condominium in North Dallas, my mother had lived there before she passed, and they did a $40,000 assessment on everybody. And, it was just, and my mom was like, what can we do? I was like, there's nothing you can do. I mean, it's just part of the deal. I mean, they're that powerful. I mean, and they can foreclose on you if you don't pay. I mean, it become really problematic. So we stay away from that. Look, our Texas 3 bedroom, 2 bath, brick house, hopefully built 1970s or earlier, right? I mean, that's the perfect model for us. Now, I would say you can go a little higher, right? $500,000 or $600,000, right? But it's like you said, it's very market dependent.
Yeah.
Like you're in Austin,
Yep.
that is a different world than here. We don't play a lot in Austin because there ain't a whole lot of $250,000 loans you can do on houses for Austin, right? I mean,
Yeah,
that doesn't
that's so true.
exist.
Yeah.
Now, it looks like a $250,000 home. I mean, there's plenty of those, but they want $750,000 for it, 800,000, and you're just like, you're always scratching our head looking at it, going like, you got to be kidding me. So,
Hmm.
very, very market dependent. And like we said, we focus on workforce. Like one of the states we're in is Tennessee, and Tennessee, Nashville is their Austin, right?
Yep.
So we do not do a lot of deals in Nashville, but Chattanooga, Knoxville, we love it, right? Tons of the workforce housing that we really like, and you can be super successful there.
Now, any minimum loan amounts, because if they're doing some other areas, like Corpus Christi might have some stuff below 200,000 pretty readily in a lot of cases in Austin, but any minimum amount of loans you're looking to do?
Yeah, so it's changed over time. Like when I first started, there was no minimum. I mean, I did $50,000 loans, $70,000 loans. Now our minimum, the loan cannot be less than 100 grand, and the value of the property not less than 150. Right? So $200,000 loan, $140,000 or $200,000 property, $140,000 loan, we can do that all day long. We don't have a problem with that. But yeah, too low. Look, and problem with the too low is you can't refinance those. You cannot refinance those.
Yeah, a bank doesn't want to do a loan anything below 100, and even
Nope.
at that case,
And
because
barely
there's
that.
specific limitations on what they can charge as far as points and fees and stuff like that. As the next mortgage broker, anything below 100, you're losing money on realistically in a lot of
Correct.
cases. So,
Correct.
now let's talk a little bit about. We talked briefly. Hey, a bar, brand new could do it if they got some country. If somebody's doing kind of a, let's just say lipstick kind of thing, paint and carpet, and
Yeah.
it's really about all it needs. They still
Yeah.
need to have a general contractor if they bring in bids from their Certa Pro and the carpet guy, and that's what they're doing. Will that suffice and help them get rock and rolling
Yeah.
too?
Look,
Okay.
if you give us a realistic bid, like, look, like I said, we've looked at 50,000 deals. We funded over 11,000 deals. We know what something should cost. If you really don't have that much to do on the property, you just got it at a really good price, we're fine with that. We're just concerned when you start moving walls and doing things like that, you got to have someone who knows what they're doing. And hopefully, like you said, it's not you.
Yeah, and I would not be doing and moving walls right now. I would
Right.
be wherever you
No, I'd
can
be
get that
scared to
mark.
right now.
Exactly. Get it listed and don't list it at full value too. List it, but leave a little bit of meat in the bone to get multiple offers as
Yes.
well. Now, if somebody's coming to you and you mentioned they need to have a 650 FICO score or greater, have probably the better rates, what are some other things they need to do? Does the property need to be in an LLC or in their personal name or an IRA? Um, uh,
So So it depends, right? It's kind of state specific. Like I said, we're in 10 different states. Most of our states, you can do it as an individual or as an LLC. Uh, we do pull credit, right? So we do have a credit requirement. We also want to see at least 2 months of bank statements. And our kind of minimum cash wise is $15,000 of cash in the bank or 25% of the rehab amount, right? If you're going to do a $100,000 rehab, we think you should have $25,000 because what we've learned is that your $100,000 rehab did not cost you $100,000. It's probably 10% to 15% more than what your bid was. So you got to have some cash in there and you got to be prepared for the uh-ohs of real estate, right? I mean, no deal goes perfectly smooth. It just doesn't happen. There's always a few little hiccups. And if you have, like my favorite is the guys say, no crash, no credit, no problem. I'm like, yeah, we don't believe that. We don't believe that. Sorry. The fantasy, that's a fantasy, right? Yeah.
Was it Russ Whitney's stuff like that's not quite a reality these days like it was 30 years ago.
Yes. 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 Those late night TV guys, right? Everything like that.
Yeah, exactly. Now, you said that some savings in there. Should they also, once they take out a loan, what's the length of the loan? We're talking 6 months, a year. Do they need to make payments every month, every quarter, or can it be deferred till the house is sold? What are some of the terms aspect of it?
So typically on our loans now, we started off, they were 6 month loans, right? Now we know the market's changed a little bit. So now we're doing 9 month loans, right? If you come to us and it's a bigger project, you need to do a 12-month loan, we're fine with doing a 12-month loan. Um, and we do monthly interest payments, right? We want to do that because look, like you said, I have a fund and I pay my fund on a quarterly basis. So I need to be collecting payments on a monthly basis, right? I mean, to us, it's very, very simple. We make you a loan. We expect you to make the interest payments on a timely basis. And then when the loan sells or the property sells or you refinance out, you pay the loan off, right? And we'll extend the loan, right? We understand things take time. Typically, we'll do a 90-day extension for 1 point. And oftentimes we'll put that point on the back end. We can wait to that. But we do need the monthly interest payments to be made.
Awesome. And I'm sure that taxes need to be paid up to date upon closing, along with a year of insurance basically paid as well too at the time of closing.
Yeah. So, we close with a title company. Obviously, you get title policy, owner's policy, lender's policy, all that good fun stuff. And then insurance for as long as the term of the loan, right? So if we're doing a 6 month loan, 6 month, 9 month, 9 month, 12 month, et cetera. And of course, taxes up to date and at the time of closing, title company makes sure that, every state's a little bit different on when they collect their taxes and everything like that, but at least you'll get the pro rata amount and everything. But yeah, we do not just, you guys listen, we do not escrow for taxes. We do not escrow for insurance. That's all paid up front. This is a short-term bridge loan. This is not supposed to be a 30-year fix where we're escrowing things like that. That's not what we do. We are just short-term bridge money.
Now, what kind of rates are we seeing these days? I know it'll vary depending on a little experience and stuff like that, but what kind of interest rate and points are somebody looking at?
So depending on borrower's history with us, like if it's a newbie, typically it's like 12% interest rate, 3 points. Experienced borrower, we can go down to, between 10 and 11, depending on their experience, and down to 2 points, right? Maybe depending on the deal, sometimes, I've got guys we've done 25, 30 deals with, man. Maybe they get a little better deal, but we kind of work up to those things. And what we're also doing now is kind of offering people a choice, right? Like, do you want the 12% interest? Do you want the higher interest and maybe lower points, or, higher points, lower interest? Kind of played along. And I think borrowers, it was so interesting. I always thought that they would all just say, I want fewer points, higher interest because I'm getting out of my loan fast, right? Well, now the way the market's going, some of my folks have said, no, I'd rather have the lower interest and I'll take the higher points because I know this is going to take me longer. So, The market, the market is always shifting, and I think you got to kind of adapt your strategies right to the market.
Well, that's important. And some people out there, if you're brand new, like, oh my God, 12% or greater. Like, listen, it's a short-term loan. We go back to the same analogies, we were creating a $300,000 house, they're lending up to 210. That's 210,000. If that's somewhere between, let's just say you sell it at 300, but net 90%. That's 270 you're netting after closing costs, commission, some things. That's $60,000 difference. And you did it in 6 months instead of paying 12,000, you're paying $6,000 in interest on it. You're still coming away with a deal. It's better to make a whole lot of a chunk of something than a whole lot of nothing, right?
Yes. Yeah. Yeah. And I think the more experience the borrower gets, they really don't care about the interest rate, right? They are about speed and efficiency and can you get me my money? Can you close the deal? And, one of the things, especially if you have new folks getting into this, and I strongly encourage them to talk to other lenders, how long does it take for me to get my draw money? Because nothing slows you down like not paying your contractor on a timely basis, right? Or if you don't get reimbursed fast enough because you paid your contractor and then the next payment's coming around because you're set up, you're paying weekly or every 2 weeks, but your draw hasn't come in, then you can't pay your contractor, you're not going to see them at your project then. They will not show up, right? We've learned that. They need to be paid. So you want to make sure. I think a good lender will get you your draw money in 48 to 72 hours. If somebody's telling you it's going to take longer than that, you need to ask them why, right? Because that's a problem. Because we all use third-party inspectors. Now, some of the guys are going to virtual inspections now, which we've started doing, which speeds up the process. But even if they use third-party, they get out there, they get them report. It should take 24 to 48 hours from the time they get the report to turn it around to you. If it's taking them longer than that, that means they don't have the money sitting there ready for you, and that becomes a problem for you.
Yeah, we dealt with a phone call from an investor of ours who was like, "This investors want me to make my huge interest payment before I get reimbursed for stuff." I'm like, "Well, that's because they probably don't have the money in their account to pay your repair costs. That's why they're requiring it. And they say if I don't pay, they're going to default to me, but they owe me this money. I'm like, it sounds like they're a little tight in capital."
Yes, yes. Over the years, we have heard those stories. Yeah, I mean, look, it's funny, Scott. Nothing you or I is going to say is going to surprise the other one,
Yeah.
right? We've heard it all in this. And, now our industry is changing, though, a lot from when I started, right? You asked me more competition and stuff like that. There's definitely more lenders, but there's institutional quality lenders now out there. And it's interesting because they are cheaper price, but they act like a bank. I mean, if I'm going to tell you I'm going to close in 5 to 7 days, they're going to close in 2 to 3 weeks, right? I'm going to tell you I'm going to get your draw money in 48 to 72 hours. They're going to be 4 to 5 days. I mean, it's just the hoops you have to jump through. You've got to really make a decision. Is that 1 to 2 points cheaper on interest worth it to go through all these extra hoops and all these other things that they do? Because this didn't exist when I started and you started doing this stuff. Institutional guys were not involved in our space.
No.
They were not there. They have come in. They're here, and they're not going anywhere.
No, they're not going anywhere. But that's one of the biggest things I have to commend you for is that draw time, 24 to 72. Now, this is business days. Don't come expecting a Friday at 5 o'clock and you're going to get funded on Monday morning. It doesn't work that way.
Correct.
It's going to, that's business days. So 1 to 3 business days is very normal and ahead of the institutional side of things. So it's going to take 24 hours for a wire to go out and hit your account anyway, for the most part, right?
Correct. So I think most groups, you can wire same day, right? You can do wire, but most groups ACH the money directly into your account because if they wire, it's going to cost you money, right?
Yeah.
A wire is $15 to $50 depending on the bank and everything. ACHs are free, so most guys will use free, and they'll send you a notice of deposit. You'll get an email notification, money's been put in your account, and it's there the next day. But yes, that is business days. That is not. Friday at 5 is my favorite, right? Friday at 5. I'll have the money Monday morning, right? And, come on, it's going to be like Tuesday or Wednesday. Be realistic. Now, banks are trying. ACHs now, they have same-day ACHs. So banks are getting better at giving money because, there's all this new fintech coming around. And, I can Zelle you or I can, Venmo you money and you get it the same day. So the banks are they're playing catch up a little bit, and everything. Now,
You never understood that. They could take our money all day long, debit cards, but couldn't actually credit things over weekend. And I think that's more so on them slowing it down so they get a little bit more interest on our money
a
sitting there in accounts.
1,000%. There's no thinking about it. It's 1,000%. Hey, you were a banker for a long time at Chase. I know this.
Yes.
You know the deal. When you have a little bit of money from a whole lot of people and you get to hold on to it another day or two, it's real money.
Uh-huh. Uh-huh. Seen enough IRA rollovers from Wells Fargo and other things take 6 weeks to roll over and they don't wire. They send a check so they can hold on to it for 6 more weeks.
Yes, yes,
Money's
yes.
pulled out of your account into a special account, but it's held on to them for another 6 more weeks.
Yeah.
Now, any other things that you see kind of popping up on a regular basis in different parts? So let's just focus on Texas here for the time being here.
Okay.
We've seen like more roofs needing to be replaced in areas like up in Dallas and Fort Worth because of issues with storms,
Well,
flood stuff in Houston, obviously.
so Texas, right, is so weather dependent, right? Everything seems fine. We can have a crazy storm, and then like all of a sudden I get a call from my guy and go, yeah, we got like 50 people need new roofs. I mean, it's crazy. So I feel of all the states we're in, the Texas is the most volatile when it comes to that, right? And it's just so weather dependent, right? We've had a very mild fall. I guess we're in fall, so to speak, and everything. It hasn't felt like it temperature wise, certainly not in Dallas. I don't know about in Austin there.
I was out walking this morning and I broke out in a full sweat. It's like still 83. It's 83 degrees here right now. You know
Yeah,
what I mean?
yeah. So we haven't seen any extreme yet and everything. And then look, Houston's the one that always scares me, right? Because my bars in Houston are like, do I need flood insurance? And I'm like, do you need flood insurance? I'm like, well, you don't technically need it, but since your area, the home you're buying has flooded 3 times in the last 10 years, we would recommend you get it. But it's so expensive. I'm like, yes, I understand it's expensive, but you know what's really expensive is if your house floods and you don't have flood insurance, right? That is a real problem. And that happened several years ago down in Houston, right? And then the insurance companies, right? Because certain areas of Houston flooded because they raised the levees. And when they raise the levees, they say it's a man-made problem, so insurance won't cover that. And so it is super tricky on this stuff. But yeah, Houston, we're always very, very cognizant of flood insurance and everything. And then Dallas, look, it's certainly DFW, Austin, it's just so weather dependent.
Now, let me ask you a question, because obviously Texas is huge and we've got a lot of wide open spaces. Is there
Yes.
a size of the area town-wise that you won't lend in? Like we're talking,
Yes.
it's like out in like Edna versus Houston, or like down in the valley, out in the middle of nowhere.
Yeah. So we don't land in the middle of nowhere. Yes. We try to be in major metropolitan areas, typically within 40 miles of a major metropolitan area. We like this at least 10,000 folks living in the town,
There we go.
right? Is what we like population. But we want that for you as our borrower, because if you're trying to flip the property and nobody lives in your town, who are you going to sell to, right?
Hmm.
Doesn't make any sense. Our whole thought process is how can we help you get out of the property, right? And if you're going to be in a Podunkville, which we have a lot of in Texas, we have a lot. That's not the best place for you to want to fix and flip, or even create a rental because there's not enough. The population's not there.
Yeah.
So yes, we do have certain criteria. If you ask us in the middle of nowhere or something like that, we stretch out 40 miles, right? So if you're in Fort Worth, 40 miles in a direction, Dallas, Houston, Austin, San Antonio. We'll do Corpus. We really don't participate down in the valley because the valley is kind of its own world
Hmm.
in Texas. So we kind of stay away from the valley. We just want to be in places where folks we think have the best chance to succeed.
Well, and that's the thing. You don't want to set people up for failure because you're speaking my language. Like if you're in a small town, it might get it a heck of a deal, but if you've got a 360 days on market, you don't have a deal there. Your money's gonna get all eaten up with different fees and stuff like that as well for you. So understand your numbers and go through it. And how hard is it for folks to run a deal by you got your team there to see if it makes sense?
Super easy, right? Super easy. We have loan officers in every market. And, if you contact us here, we'll put you in touch with them, reach out to them. We've got an app we use. We can send out, give you a quote. We can look at a property, and 5 minutes later, we can send you a quote out. Super easy for folks to, by the way, we don't call them loan officers. We actually call them loan consultants because we want them to discuss the property with you. They're supposed to be the Scott, are you still there?
I'm here. I just
Oh,
was sharing the your website for those that are
oh,
watching the video there for
oh,
you.
I was worried like I cut out on you or something. Like, I didn't know
No, you're
what
still
happened.
here. Yep.
But yeah, you go to our website right here. You can see
LonghornInvestments.com. It's Longhorn Investments, just like it sounds and spelled.
exactly. Hit the apply now button. You can get pre-approved. You can have us look at a property. And we, our loan consultants, we call them consultants because we want them to be experts in your area, and we want them to tell you if it's a good deal or if it's not a good deal, right?
Hmm.
They know it. Like most of our loan consultants, they're flippers themselves, so they know good deals, right? And they don't have to wait for underwriting to say, hey, this is good, this is not good. And we try to lay everything all out right there.
Hmm. Now, a pre-qual form.
Yeah.
Let's talk about that because I always joke about there's people out there just issue pre-qual if you got a heartbeat, kind of like they used to do loans back in early years, stuff like that. But
Yep.
you're
They still do
wanting,
that.
they still do it. There's still a lot that do
Uh,
it. But you guys, you're going to want the people basically, hey, just to get kind of signed up, ID, driver's license, uh, proof of assets, money in the bank, and stuff like that for you. And,
Yep,
and,
we have
and
online application. You go fill it out, and it'll tell you all the stuff that you need to provide us. That meets all the criteria. Boom, we'll send you out a pre-qual letter. Not a problem.
Mhm. There
But
you go.
we are still underwriting. We're underwriting you. We are not. Now, it's funny you say that because when people want to do a refinance, we tell them to bring us a pre-qual letter. The problem is there's a lot of lenders like you just discussed that, hold on, you're breathing? Yeah, all right, here's a pre-qual letter. Uh, we don't love that.
We'll make sure it's real.
Yeah.
And actually worth more than the toilet paper it's written on.
Exactly. Exactly. Exactly.
Now, let's talk a little bit. Let's twist it here a little bit
Sure.
and dive in and talk about your other fund, the big fund with the
Yeah.
$222 million. What are you guys doing with that for those out there that
So
might be interested in investing?
so that is what funds our loans. So Longhorn, like you said, is the originator and the servicer of the loans, and Trident funds all of our loans. So look, this is why if I want to close a loan, I don't have to go ask a committee or do anything like that. We manage this fund. This fund is there just to do our loans. And so I think we're up to about 225 million of capital right now. And I've got two lines of credit, right? So I have a syndicated line of credit with Veritex, now Huntington Bank, for 191 million. And then I've got a line with Atlas SP for 250 million. So we have the ability to lend up to over, $650 million in loans. And we've got, I think right now, about $450 million of loans on our books and everything. And we balance sheet, we don't sell our notes. Although I was watching one of your podcasts, I'm like, maybe we should talk about note buying. I mean, maybe we should talk about that. Exit strategy, man, exit
It's
strategy.
an exit strategy. Yeah.
That's right.
I mean,
That's right.
if you got some stuff and people got an IRA sitting there with lazy assets on the side and they want to make an above average return than what they're probably getting, might be something to think about.
There's that. Although I think you're more fixed on the 30-year or the longer term notes, right? Which makes more sense if you're buying it. Ours, obviously, the short term notes and everything like that. But yeah, so what we do is Longhorn underwrites it, Longhorn approves the deal, and Trident funds the loan. So if people go look up in the county records office, if you're looking for Longhorn, you're not going to find us. Trident Realty Investments is the lender in all of our transactions.
Very nice. And if are you looking for investors or accredited investors for
Always.
the fund?
Oh, we're an evergreen fund. We are always looking for money. 506 Reg D. So we can't solicit, but if you saw it on this here, certainly you can come talk to us. You're a friend of Scott's, Scott's a friend of mine. Super simple.
Yep.
And look, my goal, that fund has been around since 2012. So it's an evergreen fund, so perpetuals, a 1-year lockup period. And then my goal is to get you 10% return on your money. That's been my goal. And I think out of the last 13 years, 11 years, we've hit over 10, and 2 years we've been at 9 or above. I think 8.93 might be the lowest, and I think that was COVID. I think that was 2020 when we weren't sure. Frankly, we weren't sure if we should be doing loans, right? Turned out it was a great time to do loans, but in the first, March of 2020, the first 3 months, we were all very, very nervous about making loans at that time.
Well, yeah, when you had, especially like we had a portfolio of stuff that stopped paying, and you don't expect that and not be able to do the foreclosure process on it. So yeah, it's difficult.
That was a something that was not on my bingo card to predict for that year that the government would say, yeah, you don't need to pay. You can stay there. You don't need to pay. Don't worry about it.
Yeah. Now we have seen it. I think I did see with the first, like April was the first month that Harris County did foreclosures after like 6 months. It's like, oh, a lot of hard money guys foreclosing. People stop paying for 6 months. It
Yes.
just happens stuff like now. If you end up taking stuff back, do you have
Yeah.
REOs for sale, or do you just turn around and list them
Yeah.
and go that route?
Yeah. I mean, listen, I have borrowers that say, hey, if you have REO, send them to me. I send them to them. We list them on the market. I've learned I want to get rid of an REO as fast as possible. I just want to get my money back, recycle it, go do another loan. I don't want to. Unfortunately, I have built brand new homes. I've knocked down homes, built brand new homes. I've repaired, I've remodeled, I've done all those things. Economic wise, sell it as fast as you can, is what I've learned.
Velocity of capital, time value of money. You can get that money in and get it working for you for sure.
Yes.
Versus, and that's why banks don't want to own your property because it's technically, if they got an REO, it's a non-performing asset that's not generating any income. And
And they can't leverage it.
nope, they sure can't. They sure
Yes.
can't. Definitely not.
Yeah.
Now, where and I'm kind of actually looking to a ball here. Where do you see 2026 going? Are you think that we're going to see more people diving back into buying more homes in Q1 if the rates go down, or they decide to pass a 50-year mortgage? I mean, that's more on the consumer side, but on the fix and flip side, where do you see opportunities maybe lying?
So that's an interesting thing that you brought up is that we've kind of studied, right, over the last 15 years what affects our business the most. And it's actually the 30-year fixed rate, right? When the 30-year fixed rate is down, our borrowers can sell their properties much faster. When the 30-year fix is up, it slows down, it clogs up a little bit, it's a little more challenging. So, what I see, look, I hate the crystal ball question
Yeah.
because it's just impossible to predict. Look, part of the reason that we have our current administration is unpredictable, right? And some people can think that's a good thing, and some people think it's a bad thing. For our business, it makes it more challenging, right? There's two things that I am wary of going into 2026, right? One, what is the Fed going to do, right? What are interest rates going to be? Because it seems like every time they lower the rate, nothing happens because it's already been baked in. So we've already baked it in. It's not helping us a whole lot. And I am concerned about labor shortage, especially in the states we lend in, right? Is that the workforce has been leaving. And whether it's being deported or self-deporting, and that causes a challenge in the construction business. I mean,
Yeah.
that is a problem. So all that being said, the last 2 quarters, Scott, we've done more loans than we've ever done in the last 2 quarters than we've ever done, right? Because look, part of what's happening in our space, institutional guys have money, but a lot of the smaller guys, their money's not being recycled as fast. So they don't have the cash to close. And we, fortunately, we do. We are able to close, right? We have our lines of credit, we have our capital. And so our volume has been picking up the last 2 quarters. Now, traditionally, Q4 is a little slower. Thanksgiving, Christmas, New Year's, people kind of slow down. Then January, people get all revved back up again and fire back up. And then January picks up a little bit. February, March, usually better. But man, I don't know. Like, look, I got to be honest. After 2020, I'm out of the prediction business
I know, right?
because I thought in 2020, I had been saying rates have got to go up, right? All the indicators said rates need to go up. And so we expected rates to go up and, things to get a little more challenging. And then, COVID happens, rates are at the bottom. And look, everyone that stayed in the game, right? If you could stay in the game, your business went crazy the next
Mhm.
2 years.
Well,
So
but it's the thing too. I totally agree that the price and interest rate in a 30-year mortgage affected. But I also crack up thinking that what a rate is now used to be a really good rate back in 2007, 2006. You know what I mean? People got
yes,
spoiled on the low rates, whereas a 6%, 7% interest rate for your 30-year fix was a great rate. I mean, my mom's and dad's house was 18%, and that was the first loan I refinanced back in 2001. You know what I mean?
yes. No,
So,
and by the way, so what we have thought about is that we don't need to see interest rates go down. We need to see interest rate acceptance. We
mhm.
need people to say, I'm stop waiting for rates to come down before I sell or before I buy my home. We need acceptance coming in because, like you said, this is not a bad rate. It's not, I mean, it's all just relative, right? We have recency bias, right? Oh, I want 2 or 3% loans. That ain't happening again. That's not happening. Ask your parents about their 12 to 18% loan and tell them you're getting it at 6, and they'll be like, buy. This is a great time to buy. Your dollar's going far. Um, so
Well, but
that,
it's also too. I think you have a lot of new buyers that want that perfect forever home. And
Yeah.
most of us, like, forever home didn't come till 20, 30 years after I bought my first home to get into it because I'd save on money and now have all the write-offs and tax deductions or have the home office that I could do. You want to work from home? Great, go buy a house.
That's right. And I think, and you probably know better than me, but I think the last thing I read said the average person that buys a home to live in, right? And let's say they get a 30-year fixed mortgage and all that stuff, they typically are in that house no more than 7 years,
Yeah.
right? And so, yeah, you don't need perfection, especially starting out, right? The 250 to 500,000. Everybody wants that, fancy schmancy home, but like you said, I don't know, my third one, right? By the third one, maybe the fourth one, then we're that. Then you're in your forever home, right?
Mm-hmm.
And even then, that's not forever because at some point, then everyone moves out, and you're like, why do I need all this big space? I can go to a smaller house and everything.
Well, that's what I always check, especially these days when you see all the argument about a 30 versus 50-year people, all the interest you're going to pay. I'm like, I don't know anybody that's lived in a house for 50 years for the most part. You know
No.
what I mean? They're out of it in 7 to 10 because, they're refinancing they can refinance usually after 2, 3 years,
Yep.
to a better rate. But the whole getting in, real estate's not going to get any cheaper. So you might as well grab what you can any way you can get it
Yeah.
these days. One question I wanted to ask you that I think maybe folks don't realize out there when they're buying an REO or a fixer-upper is kind of the seasoning that the end financing often wants to see of you owning the property for 90 days to get full value. Are you still running to that if a flip goes fast, if 30 days, where the underlying new lender doesn't want to give full value to the fix and flipper?
So we are not seeing that as much, right? So maybe the government loans, maybe Fannie and Freddie, they want to see that, but there's so much other, institutional money, non-government money in that the seasoning really, that was a problem, right? A long time ago.
Yeah.
We really don't see that as much of an issue anymore. And by the way, nobody's flipping. No one's getting their rehab done in 30 to 60 days anymore anyway.
We had a couple that we did that we ran actually just recently.
Wow.
It's kind of funny. They wanted us to make sure we held it for 90 days, so we just pushed the closing out from 30 days to 45 days.
Yeah.
And that got beyond the 90-day period. But yeah, it's I agree, less of it, but
Yeah.
it's when we buy notes and end up taking back, that might be the thing they always seem to have a hard time understanding. What you mean, you're flipping the property? No, we were the bank. It's an REO. If B of A can get full value on REO, we should be able to get the same thing.
Absolutely.
Yeah.
Absolutely. You're the note holder. I mean, you are the bank. Yeah.
Right.
Yeah.
Let me ask you a question. If
Sure.
somebody's buying debt and they do take it back at a foreclosure auction and then clean property, doesn't need a lot of work. I'm sure, would you guys do a refi if I wanted to say refinance out my private investor who funded the note purchase and needed to pay them off because they didn't have enough money to fund the flip, to bring in a hard money lender to fund the flip and rehab on it?
Yeah. So we typically look at how long they've owned the property. So in the scenario that you're talking about, if it's within 30 or 60 days, absolutely, right? We love doing that. We're always a little hesitant when the guys own the property, and it's usually not the scenario you're talking about.
Right.
It's usually the scenario where they inherited the property and they've owned it for 18 months or 24 months. They haven't done anything, and now they're ready to do something. We're like, well, it makes us a little leery because we cannot do owner-occupied loans, right? We're not licensed for that. So we're always a little leery that they might be doing it for that. So we kind of stay away from that. But in your scenario where they took it back and, they've just had it for, a couple of weeks, something like that, yeah, we absolutely would look at that.
Yeah, because we're looking at some reverse mortgages where the borrower's deceased. We're buying the debt at about 60 cents on the dollar of value of that, market value comps, and looking to refinance out our private investors to do a little like paint and carpet on some of that stuff. So I'll run some scenarios by, and they're all in major cities: Georgetown, Texas; Rosenberg, which is Georgetown, San Antonio; Rosenberg, which is in Harris County.
Yep.
And then Midland. Do you do now Midland, Odessa area, San Angelo area?
So we don't do Midland, Odessa. Boom and bust towns make us a little scary. Lubbock, though, we would do.
What about Tyler?
We've done deals in Tyler, yes.
Okay, I'm just asking. I'm not holding you to anything.
No.
You know what I mean?
And by the way, what's interesting too, and we didn't really talk about it though, just because it's in the city, like if it's in San Antonio, if it's in Dallas, it doesn't mean we'll do the deal. Like we don't want you buying a house and trying to fix it up and flip it when it's in the middle of a commercial area, if it's on the busy intersection, right? We've seen enough of these. If it backs up to the highway, like we know that people don't want to live in those locations, right? And even though you have good comps, your comps though are not specific to that piece of property. And you and I both know property is unique. Every piece of property is very unique. Just because you have comps, it's not the exact property that's sitting there on the corner of the busy intersection. 10
Yeah.
houses into the neighborhood's a whole different ballgame.
Yeah, exactly. And that makes sense. If it's got to be a marketable property, probably got to be over 1,000 square feet. I'd be willing to bet as well too.
Yes, we're not in the
Uh,
one ones. We're not in the one ones.
well, I saw a 2-1 from I guess you could say competitor out there. They got a string of REOs that I just saw. I'm like, ooh. I said, why did he or she lend on this property? It's a piece of shit. You know what I mean? My realtor, I was going to drive by one in San Antonio, and my realtor said, "Oh no, Scott, avoid that area. It's got like 12 months of inventory in
Yeah.
that area." I'm like, okay, why? Just
Yeah.
not a good deal.
Well, and here's what I'll say on that. Um, I think a lot of lenders have had to learn how to underwrite over the
Yeah,
last 2 years because let's say you started in this business in 2017, right? Or 2016. The market's been going like this. You could have underwritten like crap, right? And I talked to a guy that's been in the business 35, 40 years, and he was like, I've never underwritten such shitty loans in my life, but the market's been so good, it took care of it. Well, guess what? Rates change in 2022, 2023. If you're not underwriting right, you're going to be in trouble. And there is a lot of lenders uh, who are struggling now because of that.
yeah, amen
Um,
to that. Like
I
you
mean,
got to evolve like anything else. Same thing. We got to adjust our numbers more buying debt and things that we do as well out
for
there
sure.
because it's changed. You got to understand that buying habits have changed, days on market change, markets change. All sorts of stuff's going on. It can affect whether it's a good deal or a bad deal out there. Now, do you guys do any commercial or just strictly residential stuff?
So we used to do a lot more commercial. I think, there was a period there where there just weren't any commercial deals being done. And of course, everyone's terrified of office space now and things like that. We would do like up to 25, 24 units, right? Commercial apartment complex, things like that. What happens oftentimes is people can find cheaper money than us,
Yeah,
and we encourage them, don't be foolish. I mean, there's a time and place for hard money, but it's not for everything.
yeah,
So if you can get a better deal, get a better deal. We have some borrowers that we've been doing business with for years and years that buy commercial properties that we do deals with them and they understand us. They want speed, efficiency, things like that. So not a lot. I really think the last time, Scott, I looked, I had less than 5 non-single family home properties in our portfolio.
yeah.
So
That's probably what I expect, especially where the market's been chaotic there.
yeah.
Definitely. And I'm assuming only first liens, no mezzanine, second liens, like we see some other folks out in California and stuff, right?
No, I need to talk to you about California. I don't understand California, but I've talked to some lenders out there. They're doing seconds and thirds, and they say they can do business purpose loans on homestead properties.
Okay.
And I was not aware of that. I was not aware. But yes, we are a first lien lender only. That's it.
That's because you're sane. I
Yes.
mean, you're not,
Yeah,
and
I
that's the
agree.
thing. You know how to make money. You ain't got to get greedy on desperate. But that's the thing. I don't buy anything in California. It's the crazy state of California out there just doesn't make a lot of lending sense in a lot of cases. But that's why Texas is here. It's one of the friendliest, and the other areas. Are you doing mostly non-judicial states or doing anything in judicial states?
Yeah. Try to stick with non-judicial. I think Indiana's judicial, North Carolina's quasi-judicial,
Yeah,
um, and Ohio, I think
it's judicial.
judicial.
Yeah, yeah.
Yeah. And then other than that, we try to stay in non-judicial foreclosure states.
Yeah, well, Ohio, Indiana, under 9 months to foreclose. Well, about 9 months, but Indiana, you can evict or especially Indianapolis, like 14 days you can evict, which is really nice.
Evicting is not the issue, right? Evicting
No,
is not the issue. It's getting the property back because I mean you have to file a lawsuit, and there's just
yeah,
no fast way around it. So we try to communicate with our borrowers, right? Even if things aren't going well, let's communicate. And if we can do a deed in lieu, I'd much rather do a deed in lieu, right? The
yeah,
only time I got to foreclose is if you won't communicate with me, or you've allowed other liens to be put on the property that I have to try to wipe out via
hmm,
foreclosure.
yeah.
But
Well,
that's it.
that's it. Awesome. Well,
Yeah.
once again, guys, best way, Mike, for the folks to reach out is at longhorninvestments.com and connect with you down there
Yeah,
and your
absolutely.
team.
Absolutely. Longhorninvestments.com. Check us out. We've been around forever. It feels like, you know, the good thing about us is I'm not the cheapest guy in town. I'm not going to tell you I'm the cheapest guy in town, but we do what we say we're going to do. If we tell you we can close the loan, we're going to close the loan.
All right. Well, that's why I reached out to you first when we launched all the different podcasts in Texas for it, because I knew you guys do what you do. You've got a great reputation. We've known you for a while, and you guys just do a great job. Second to none out there. That's what I like to say.
Thank you. I really appreciate that.
Yeah, no problem. All right, guys and gals, that's going to wrap it up for this episode of the podcast. Make sure to check it out, longhorninvestments.com. Get pre-qual, get your information in there if you'll be doing a project here before too long, before the end of the year or the first of the year, if that's one of your choices. As always, go out, leave a 5-star review, make sure you subscribe and share with somebody else. But take note, if you're thinking about investing in the Longhorn state, longhorninvestments.com for you guys. Go out, take some action, and we'll see you at the top.